A little bit about Tim. Tim Nash is the founder of good investing and blogs such as The Sustainable Economist. As an expert on socially responsible investing, impact investing, and the green economy, he's regularly featured in publications such as the CBC's The National, BNN Bloomberg's Market Call, and the Globe and Mail. He earned his BA in economics from Dalhousie University and his master's in strategic leadership towards sustainability from the Bleking Institute of Technology in Sweden. Wow, great. He was the treasurer of the Ontario Nonprofit Network, where he chaired the finance and audit committees. He is the lead researcher for Ethical Markets Green Transition Scoreboard research report, which details more than $9.3 trillion of private investments in the global green economy. Before I invite Tim to speak, as full disclosure, I have been following his blog for a while and have used one of the model portfolios that he puts out for fossil-free investing. So that's kudos for him for putting that out. So, ladies and gentlemen, Tim Nash.
Thank you so much. Yeah, Greg, thanks so much for leading this. It's it's an honor to follow you, and really kudos for the work that you're doing. There was no way I was going to jump up on stage the way that you did. So I kind of took the long way around. Figured people would give me that. All right, I might actually just take this off here, and this way I can wander around a little bit. All right, thank you so much, everyone, for having me. Mohan, thank you so much for organizing 350 Ottawa, Ottawa Public Library. Thanks so much for having me. Really appreciate it. How's everybody doing today? Good? Okay, great. Thank you for coming on a Saturday. I know it's a beautiful, sunny, cold day out there. So thank you for spending it, at least this part of it, with me. Should have a fun presentation for you. Before I get started, I can give you a little bit of a background on myself, but how many people have heard of me and kind of know a little bit about my story? There are a few of you. Okay, most of you. So I'll keep it nice and short, but basically, I grew up in London, Ontario with my dad in the investment industry. So I kind of grew up around stocks and bonds. I studied economics and philosophy out on the East Coast. So I was kind of like the weirdo in each of those faculties, asking the strange questions. In my third year, I was very lucky. I got accepted to do an exchange in New Zealand. And my intention was to go there and party and play rugby and hitchhike around New Zealand. And a few things happened that really changed the course of my life. But the biggest thing is that I took a course in something called the triple bottom line economics. So instead of the single bottom line, just profit, it was about the triple bottom line, people, planet, and profit. And for the first time, there was an economics course that started to talk about some of these sort of philosophical issues I was having with our economic system. I always described it before when I was learning these economic models, that there was always something off. I couldn't quite put my finger on it. It's almost like my spidey sense was tingling. I was like, wait a minute, something's off here. And finally, for the first time, I realized that our economic system was just completely ignoring human capital, social capital, and natural capital. That people, society, and the environment were just completely ignored. And the language that got used, they were dismissed by economists as externalities. Has anyone ever heard that word before? Yeah, so this is the bane of my existence, because that was sort of the magic wand that economists would wave to say that these things don't matter because they're outside the profit maximizing equation. Well, obviously that's not true at all, and I'll be getting a little bit into that. But basically I came back to Halifax for my fourth year economics program full of questions, and my teachers didn't have answers for me. So I graduated with my BA in economics with way more questions than I had answers. So I went to Sweden and I did my master's in sustainability. It was awesome, it was really cool. I got to live in Sweden for a year. They're just so much further ahead of where we are on a lot of these issues. I got to do my thesis looking at this topic of socially responsible investing. Now, as soon as I brought up the words ethical, responsible, sustainable, people automatically assumed lower financial returns. Right off the bat. It was the reaction I got. I was working with leaders from some of the top banks that were working on these issues, and they're just Tim, oh, that's cute. You want to save the world. Well, we're in this to make money. But what I realized is that there's a business case for sustainability. that you can do just as well, if not a little bit better, by investing in companies that are leaders in sustainability. I came back to Canada in July of 2008, ready to take the investment world by storm. Does anyone know what happened in October of 2008? Oh yeah, right, great timing on my part. So needless to say, I was completely out of luck. There were no jobs, the investment industry was not hiring, and frankly, sustainability kind of got put on the back burner. That people were just like, okay, no, we have more pressing things to worry about right now. So I spent a few months in my parents' basement in London, Ontario, sort of banging my head against the wall. And then in January of 2009, I said, to hell with it, I'm going to start my own business. So I've now been in business for over 10 years, almost 11 years. It's been through a few different iterations, which I'm going to be describing sort of, as I go through some of the frameworks. Where I've landed is that now my company is called Good Investing, and I'm what's called a fee-for-service financial planner. And so what I do is I teach people how to invest according to their values. I'm not a broker or a money manager. I never touch my clients' money. Instead, I'm more like a coach or a consultant. And I teach people how to figure this stuff out and give them the information they need and sort of empower them to do it themselves. So I'll be talking a little bit more about that sort of as we go through the presentation today. Really what to expect is I'm going to start on the high level, what I call like the macro side of things, so like big picture, global economy kind of stuff. And then at some point I'm going to sort of pivot more into the micro and look more at personal investments and give you an idea of what that looks like. I'm going to do my best to kind of keep it sort of short and snappy and keep it going. So my goal is to not get too deep into the weeds with this stuff. That said, there should be a little bit of time for Q&A that, like, if you want to take me down into the rabbit hole, like, I'm totally happy to go there. But obviously I realize most people are here on a Saturday afternoon, not to like get into the weeds. So, but know that, hey, if you want to go there, we can go there. Okay, so let me make sure I can do this. Perfect. So I'm going to start you off with the biggest number that I've ever counted to, which is $10.3 trillion. So this is the size of the global green economy right now. So basically, after I graduated, I came back, I started my own business. There were not a lot of jobs available for me, right? Not a lot of contracts. So I started working with a mentor of mine, a woman named Hazel Henderson. And Hazel Henderson is the founder of Ethical Markets Media. Has anyone ever heard of Hazel Henderson? Hazel is like an absolute legend in the space. She wrote a book in 1982 called The Politics of the Solar Age, about the need to transition away from fossil fuel economy towards a green energy economy. So Hazel is like an absolute legend and has been a real mentor for me. And back in 2009, we wanted to see, okay, like how big is the green economy? So we did our first green transition scoreboard back in 2009, where I started counting all these private investments in the global green economy. So this number actually excludes government spending as much as possible. These are private investments. One of the big criticisms when I started, everyone was like, oh, well, it's all subsidies, right? How many of us have heard that argument? That like, it's not real investments, it's just subsidies. So we actually, in our methodology, removed subsidies wherever we could. From there, it's now grown, so this is an aggregate number. So these numbers have grown every year, right? And that now the latest report, I'm happy to share with you, we've counted more than $10.3 trillion of private investments globally in green sectors since 2007. So just real quick, in terms of the breakdowns, the biggest sector, of course, is renewable energy, right? No surprise there. This is the largest green sector when it comes to private investment. From there, we've got energy efficiency. So, there are a lot of people, I'm a big believer in energy efficiency. We always say that the cheapest gigawatt is a negawatt, right? It's always cheaper to avoid a unit of electricity than generate a new one. So energy efficiency is massive. Life systems is a bit of a funny category. We struggled naming this one because throughout the period over the last 10 years, our methodology has evolved. We started to add new sectors. So one of them that we added was water infrastructure, right? Because there's this whole water energy nexus that if we're more efficient with how we use water, we become a lot more energy efficient. As well, we've included in these things like community investments that I'm going to talk a little bit about. We've included things like peer-to-peer lending. We've included things like e-learning, right? Because humans, like, we're part of life systems as well. So a lot of the investments in people and education are also included in that category. Green construction, how many people have heard of like LEED certified buildings? Yeah, everybody knows that now, yes. They're so much nicer. When you walk in, you can just notice it's better, and then obviously much more efficient, so huge industry there. And then the last sector, this is like the piece, so all the other areas, I pull data from the best sources. So I can pull the data from like Bloomberg, New Energy Finance, or like these big like Navigant research reports, right? But nobody actually does green R&D. So this is the piece that I've had to do myself. So I've got kind of an insane Excel spreadsheet. If anyone wants to look at it later, I'm happy to show you, with about 300 green companies. And then what I do is I add up their investments in research and development every year. And so it's kind of cool, like I've been able to track, for example, the growth in electric cars, right? That it used to be, you know, even 5 years ago, there actually weren't a huge number of companies that were doing electric cars, and now every single car company is investing billions. And I'm talking like Volkswagen, it's something like they've announced, I think it's like $25 billion that they're investing in electric car development. I think they're trying to make up the whole like Volkswagen Diesel gate. Did anyone buy a Volkswagen Diesel? I don't know if you'll admit it, but okay, so, right? I think they're trying to like make up for that and are now going fully electric. So it's been really cool for me to kind of do that number, and I'm happy to talk about like technology trends and, you know, can break down the figures for you, you know, if you're curious which sectors are like investing the most in research and development. So, you know, it's been quite a journey over these last 10 years. Oops, there we go. So, you know, I had my first TV appearance about this. Here's baby Tim over there, back in 2010. My first time on TV, I went up against Kevin O'Leary on the Lennon O'Leary speech to talk about over $1 trillion invested in, this was over $2 trillion, I can see the number there. So this would have been our second report, where we did $2 trillion invested in the global green economy. And, you know, back then it was hard for me. Nobody took me seriously. Obviously, you know, people like Kevin and sort of all of his ilk, they were kind of winning. They were ahead, and they were, you know, the ones just dismissing this and kind of, you know, knocking me down every chance they could get. Really, it was really quite challenging when I first started working in this space, and my, how far we've come. So this is the year-by-year growth of my research project. And again, it is an aggregate figure, right? So I would expect this number to grow over time. It's never going to go down. It's an aggregate. It'll only ever get bigger, but you can see how steady this growth has been. And obviously the acceleration. When we started this back in 2009, when we did the first report, we set this like super ambitious goal. We were like, in order to like kickstart this shift to a green economy, to move into this sort of post-fossil fuel era, that we would need $10 trillion by 2020. And that was like our big, hairy, audacious goal. And we're there, a year ahead of the schedule. So, you know, really my message for you today is that, you know, look at how far we've come, right? Understand that this is not some small little, oftentimes it's like the green economy, it's like niche, and this is like a future thing. Like this is like the Jetsons, right? We're gonna have a green economy at some point in the future. And it's like, no, the green economy is here, right now, today. It is huge. It is so much bigger than anyone realizes, to the tune of $10 trillion globally, just in private investments. And nothing's gonna stop it. Like realize that if I can, can I go back? Previous, yes. That, you know, this growth has happened in the era of Stephen Harper and Donald Trump, right? Think about what's going to happen in terms of this growth as we get governments that are actually supportive of these sectors and these initiatives, that actually recognize that this is the direction we need to go in. So we've seen this growth despite so much opposition from people in positions of power and wealth. And that now, you know, it doesn't matter. Like, you know, I remember seeing Donald Trump saying he was going to bring back coal, right? How did that go for him? Right? We've got coal companies going bankrupt. I don't think anyone is going to argue that coal is a good investment right now, right? And so now we're just gonna see that progression continue to happen. So really, this is my key message. If there's one thing I want you to take away from today, it's this, that the green economy is here today. It's bigger than anyone realizes, and absolutely nothing is gonna stop its growth. It can slow down or it can speed up. Obviously, policy does have an impact, but really nothing's gonna stop it. From there, again, when I started this 10 years ago, it was really hard. I got labeled all kinds of funny terms, right? I was a tree hugger, right? Or I was like, sort of a hippie, or, crunchy granola. So now I've got some messages for you from some other tree huggers that I found. So here we have, obviously, big tree hugger, the Harvard Business Review. Right? And forgive me for reading the slide, but I do think it's important. So what the Harvard Business Review is saying is that mounting evidence shows that sustainable companies deliver significant positive financial performance, and investors are beginning to value them more highly. This is the Harvard Business Review. There are some other, crunchy granolas. I sometimes, and I'm always trying to figure out different terms. I've been trying. So does anyone have any other words for tree huggers? Or anything you've been called as an environmentalist? If you have a clever thing, one thing, so I'll just say, here's another Gaia worshiper, RBC Global Asset Management, obviously huge tree hugger here. Companies that score highly in terms of their approach to ESG. Now, this is a very important acronym, so I want to break down this acronym. How many people have heard of ESG before? Yes, fantastic, but not all of you. So ESG stands for environmental, social, and governance. So when it comes to the investment world, we don't really talk about sustainability, we talk about ESG. And so every company that's traded on the stock market is now analyzed, and it's given an ESG score or an ESG rating. And that's basically kind of code word or synonym for their sustainability score. So what they're saying here is that companies that score highly in terms of their approach to environmental, social, and governance issues or factors tend to deliver higher cash returns on their investments than their sector peers. Right? This is RBC, Global Asset Management, saying that sustainable companies deliver higher cash returns on their investments. Here's another big hippie, MSCI. Has anyone ever heard of MSCI before? So MSCI, this is a major company, and MSCI is now a global leader when it comes to providing ESG data. There's MSCI, and there's another company called Sustainalytics. And those are the two biggest companies in the world that actually measure companies on these ESG factors. And MSCI, who is this is the research company doing this, has said that we found that over the last 5 years, companies with higher ESG ratings exhibited higher average return on invested capital compared to companies with lower ESG ratings. Shocker, surprise. Sustainable companies outperform. We now have the data, and this is over the last 5 years. This is in the era of Donald Trump. Imagine if we get, an Elizabeth Warren or Bernie Sanders. Imagine if we start actually taking these issues a little bit more seriously. That difference between the sustainable companies and the non-sustainable companies is only going to get wider. Here's BlackRock, right? That's nice, tree hugger name here, right? Just BlackRock. People have heard of BlackRock before. This is probably the largest asset manager in the world. They're one of the biggest ETF providers. So they manage I don't even know how many hundreds of billions of dollars. And what they're saying is that ESG investing is not just about doing good. A growing body of research points to a link with asset performance. Companies that manage sustainability risks and opportunities will tend to have stronger cash flows, lower borrowing costs, and higher valuations, right? This is not just a tree hugger perspective anymore. These are the largest asset managers in the world that are catching on to the fact that companies that are leaders in sustainability make more money. So the reason for this is pretty straightforward. We've known this for a very long time, that there's a business case for sustainability. Has anyone ever heard of Bob Willard? It's a book from Bob Willard. Oh, Bob Willard, he's like a legend in this space. He's from Whitby, Ontario. He is the global leader. He literally wrote the book on the business case for sustainability. So this guy's an absolute legend. He breaks down the business case so well, it is abundantly clear that companies that are leaders in sustainability, they're more efficient. They use less energy, less water, less materials, right? Their costs are lower because they're more efficient, right? Their employees are more productive. How many people want to like work for a company that's a leader in sustainability? Right? You're going to feel better about it. You're going to work harder. Studies are showing so strongly that especially students who are coming out of the top MBA programs in the world, right? They don't want to work for Exxon. They don't want to work for companies that are destroying the planet. They are willing to accept a lower salary to work for a company that is actually aligned with their values. So you're going to have employees that are going to work harder, and there's going to be less turnover. Right? So employees are going to be a little bit more loyal. They're going to stick around a lot longer. And then as well, they're just simply more innovative. That, companies that care about these issues, they're ahead of the curve. They're recognizing that consumer demand is shifting, that consumers care more and more. They want to buy fair trade, organic, ethically sourced goods, right? Like people care about this stuff. And so these are the companies that are like creating that next generation of products and services. Remember when I was doing that R&D figure, right? Companies that have higher ESG scores, that are leaders in sustainability, they're the ones that get it. They're the ones that are innovating and investing money in these products that are going to be sold to the next generation of consumers. So it's really super obvious why they're outperforming. We've known this information for a long time. Now, that's been a lot of the heavy stuff. I am going to give you a little bit of sort of the doom and gloom right now. So it's the type of thing where, I just want to take a moment to explain how important this divestment issue is. Okay, now I want to be clear here. I still want you, this isn't like an either-or situation. Everybody still, I want you to, ride your bike and, take the new LRT as much as possible. I want people to, travel locally, spend your tourism dollars in Ontario and Quebec. There's some beautiful, you don't have to fly away for your vacation. I want people to eat less meat, for sure, do all of those things. But if you're doing all those things, you're flying less, right? You're riding your bike or taking transit, you're eating less meat. If you still have money invested in the traditional stock market, the carbon footprint of your portfolio is going to dwarf the carbon footprint of all those different personal actions. So this is a study done by a firm called CoPower. CoPower, they issue green bonds. I'm going to talk about green bonds in a little bit, but they basically measured the carbon footprint of an investment portfolio. There are some assumptions built into this. Number one is that this is 100% stock portfolio. So normally it's a mix of stocks and bonds, but this is 100% stocks. And they split it up 50-50 between 50% Canadian stocks and then 50% global stocks. So a big issue is that Canadian investors, by default, right, often have a bigger chunk of their money invested in the Canadian stock market. Well, guess what kind of companies are in the Canadian stock market, right? When you look at the top 10 holdings, you look at the holdings, it's going to be oil and gas, it's going to be pipelines, it's going to be mining companies, and it's going to be bank stocks. And guess what Canadian banks are, right? Oil and gas, pipelines, mining companies. So by default, the Canadian stock market is very, very, very carbon intensive. And by default, most Canadians have very high exposure to the Canadian stock market. So what this means is that if you've got a 100K portfolio, $100,000 invested in stocks, obviously it dwarfs all those other actions. If you've got 500K, oh my goodness. And $1 million seems absurd, but I do a lot of retirement plans, and if your goal is to retire at age freedom 65, and never work another day in your life, $1 million doesn't get you super far, right? A lot of people for their retirement accounts need to have more than $1 million invested in order to just completely live off of their retirement portfolio. And in that case, there's an absurd amount of carbon footprint there. Now, I don't really like the having a child there because I don't want to discourage people from having kids. I mean, look at how cute these kids are, right? So I'm not saying don't have kids at all in this, but what I am saying is that, really when it comes to all these other actions, yes, personal responsibility and changing day-to-day actions, oh my goodness, yes, do those things. Very, very important things. But if you're doing all of those things, and your money is still invested in status quo, run-of-the-mill investments, if you're still doing your banking at one of the big 5 banks here in Canada, then unbeknownst to you until you saw this slide, your carbon footprint is way bigger than you realized. So really, I would argue that by decarbonizing your portfolio, by divesting from fossil fuels, it's probably the biggest thing that you can do to reduce your carbon footprint. Obviously, it depends on the size of your portfolio. Now, this is like the really scary slide, okay? And this is as far down the rabbit hole as I'm gonna go, but I think this is one of the most important concepts for Canadians to understand. Because I've talked about how sustainable investing, you can like make more money with it. This is like the scary slide. This is like the if you do nothing, how much trouble you could be in slide. So how many people have heard of the carbon bubble? Is this a concept people know about? Okay, great. So I see a few hands, not everyone, so let me go through it a little bit here. But here's how it works, okay? So basically, we know that we have lots and lots of oil and coal underground. That now this idea of like peak oil, like peak supply, like no, we have lots of oil, we have lots of coal, there's plenty of supply. The issue is that the value of all those proven reserves right now, right? If they were to dig up those fossil fuels and sell them to be burned, the value there is about $27 trillion, is what is currently the value of the fossil fuels that are underground now. Now, we know that if these companies execute their business plan, if they dig up those fossil fuels and burn that $27 trillion worth of fossil fuels, our climate is screwed. That we are just going to blow past all of our carbon targets. So according to the Paris Agreement on climate change, we have what's called a carbon budget. That if we're serious about limiting warming to like 1.5 degrees, or like 2 degrees, in that ballpark range, that we can't dig up and burn all of this carbon. That we have a carbon budget. And that our budget, this burnable carbon, is really only worth about $7 trillion. Which means that we're gonna have to leave a lot of these carbon reserves underground if we're serious about meeting our climate change goals. Now, the ramifications of that on the stock market are huge, because right now, these proven carbon reserves are listed as assets on the balance sheets of all these companies, right? And if we as a society decide we're actually not going to dig them up, we're going to leave them underground, what happens to those assets? They're worthless. They get written off the balance sheets. And so it's kind of similar to what happened in 2008, 2009 with the real estate market in the US. Everybody remembers that, right? This is like when I was banging my head against the wall of my parents' basement, right? We watched this crash. I watched this crash happen on live TV. And that basically in 2007, the value of the real estate market in the US was about $13 trillion. And then just 2 years later, after the bubble popped, right, the value of all those homes was worth $6 trillion. So that bubble, that housing bubble, was about $7 trillion. And that was enough to start the dominoes to cause this like global financial system collapse. What we're talking about here with the carbon bubble is like 3 times as big. That this is a massive bubble. Now it's already started to deflate, right? Because this was done, a little while ago. I think this starts from about a year ago. And does anyone know how fossil fuel stocks have done over the last year? Not very well, right? So it's the type of thing where this bubble is already starting to deflate, right? And if we're lucky, if we're smart about this, that this is going to deflate gradually over time, that the economy and the markets will sort of reprice everything very gradually. It's not going to be sort of that pinprick. However, I want to be clear that if you're just invested in like run-of-the-mill investments, a big part of your portfolio is invested in companies that own those assets. And if we get very serious about climate change, and it's an if, this global geopolitical situation right now is kind of dicey. So like, I don't know if governments are going to get serious about climate change, but if they do, all of a sudden I can see those assets becoming toxic, just like the real estate assets. And I can see a massive devaluation happening over a very quick period of time. So, I'm all about the sort of good news story that like, yes, sustainability, ESG investing, you can do better, we can find better companies, we can outperform, but this is the risk side of the equation. That if you don't divest from fossil fuels, if you keep those inside your portfolio, you might end up holding the bag when it comes to these toxic assets. And I want to be clear that all of the smart money, so things like Canadian Pension Plan, Ontario Teachers Pension Plan, Alberta Investment Management Corporation, AIMCO, all these big pools of money are starting to catch on to this and are starting to shift their money. It starts towards the ESG side, and then now like Canadian Pension Plan is doing their first carbon assessment. And so it's a little bit exciting, you know, in terms of seeing that the smart money is catching on to this and it's starting to move in the right direction. My fear is that it's going to be retail investors. It's going to be the regular people who like just own mutual funds, who never thought about what their investments were, who never made a decision to invest in, you know, carbon intensive assets, but just by default, that they're going to be the ones left holding the bag on this. And so that's why I'm on a huge mission to teach people about this and to show people the risk and then help people actually position their own money to avoid these types of risks. Okay, that was the doom and gloom. I'm sorry, I had to go there. I had to depress everyone just for a few minutes. Don't worry, it's going to come back. I'm going to talk to you about solutions and a bunch of fun stuff. So the last thing I have here is the biggest, you know, tree hugger, right? Here we are in Ottawa. I'm like down the street from the Bank of Canada right now, aren't I? Yeah. Like I can probably, like Stephen Pelosi, he should be. So this is directly from the Bank of Canada's last assessment of the Canadian economy. The climate change was vulnerability number 5 out of 6. So this is now the Bank of Canada saying this is one of the largest systemic risks facing the Canadian economy. What they say is that climate change continues to pose risks to both the economy and the financial system. These include physical risks from disruptive weather events, so things like floods, droughts, fires. We're seeing so many fires in Australia and California, like, oh my goodness, those physical risks. But also transition risks from adapting to the lower carbon global economy. So that's the bubble, the carbon bubble I was talking about, is that transition risk. If some fossil fuel reserves remain unexploited, assets in this sector may become stranded, losing much of their value. That's the bubble I was showing you. At the same time, other sectors such as green technology and alternative energy will likely benefit. So this isn't me telling you this. This isn't me being like, hey, the sky is falling, you know, like I'm a hippie, listen to what I say, let's go hug some trees. This is the Bank of Canada telling us that these are some of the largest risks facing the economy and the financial system here in Canada. I'm not alone anymore going up against Kevin O'Leary. So my take on this is my take, this is my opinion now. We have all the technology we need. And again, you know, you talked about the federal election, like, you know, I looked at the Conservatives, Andrew Scheer's climate change policy, and he now had an environment plan. It was a really bad plan, but he had an environment plan. And the message I'm getting from a lot of Conservatives right now is we need to invest in technologies. We need to innovate and we need to create these new technologies. No. We have all the technology we need. We have it. What we need is money to deploy it. We just need people to be installing this stuff and, you know, retrofitting their homes and buildings and putting up solar panels and, you know, and just really like adopting. We have all the technology we need. It just needs to be deployed. So, you know, what I'm going to talk about a little bit now is how the funding is happening. So there's this massive trend happening right now globally with impact bonds. Does everybody know what a bond is? So bond is like debt, so we're loaning money to these things. So you can see green bonds over the last few years, right? It's been pretty small. We're now looking at green bonds, over 150 billion last year. I can verify that I've seen numbers that so far in 2019, we are over $200 billion in green bonds issued. As well, there are sustainability bonds and social bonds, which I'll talk about a little bit, things like community bonds and things like that. Here in Canada, again, this is now becoming the norm, right? So Canadian Pension Plan, CPPIB, issued a $1.5 billion green bond. It went so well, they decided to do a second one, but they did it in euros. They did €1 billion, and it's because European investors are a little further ahead on this. So when it comes to green bonds, very popular in Europe, so that's why they did it in euros. Province of Ontario issued $4 billion. The City of Ottawa, $102 million in green bonds. I'm pretty sure this went to pay for the LRT, right? So don't blame the green bonds for some of the problems, but this was like where I think some of the money came from. Scotiabank did $500 million, TD Bank did $1.5 billion. I just saw an announcement from Scotiabank where I think they set the target, I'm going to forget it, but I think it was something in the ballpark of activities. They want to do something like $200 billion in financial activities, not bonds, but like that'll be part of it over the next decade. So like everyone's kind of like jumping on board here. Again, like these are not tree huggers. These are not like environmental organizations telling you to buy green bonds. Like this is how we are financing the future. From there are some local organizations, obviously, that we love. So how many people know of CoEnergy, right? And I think we're gonna maybe hear something a little bit more about them. How many people have heard of OREC? Ottawa Renewable, yes, you guys are awesome. So I won't go too much into those. I will point out Tapestry. Has anyone heard of Tapestry Community Capital? So this is a smaller, there we go. So they're working with nonprofits and doing community bonds. So they now do the back end. So if you're a nonprofit that wants to raise money to buy an asset that's gonna like generate income for you, nonprofits now have a really cool, can access these bond markets through community bonds. Which I'm a huge fan of. So again, I can get more into the details. If we want to talk about this, we absolutely can. Okay, now I'm going to shift focus a little bit to the micro to talk about all y'all and your investments just for a minute. So basically my journey is, as I was figuring this stuff out, I was really lucky. I got an early inheritance from my grandpa. It allowed me to pay off my student loans and gave me about $6,000 or $7,000 I wanted to invest in a TFSA. So this was back probably like 2014, no, probably 2012, 2013. And so I started looking around and I was like, how do I want to invest my own money? And I came across this guy, the Canadian couch potato. Has anyone heard of couch potato investing? Amazing. So this is like buy and hold. This is like probably, arguably, a lot of people would say the smartest way to invest your money right now is using this couch potato approach. So this is like a standard couch potato portfolio. You can see there's a mix between stocks and bonds. We're going to be nice and diversified. And then for the stocks, you can see there's a healthy mix of Canadian stocks, US stocks, international stocks. So we're going to be nice and diversified by geography. The problem is that I actually looked what was inside these couch potato portfolios. And has anyone like looked at the companies inside? Right? And it was like, it was gross, right? And these are the things that I was just like, no, thumbs down. Like I can't, like Exxon, are you kidding me? Philip Morris, which is tobacco, Lockheed Martin, which is weapons, TransCanada, pipelines, Barrick Gold, are you kidding me? They've done some horrible things. Any other companies that I don't have on the list that people are just like thumbs down? You can just yell them out if you want. Anyone? Irving, I don't know, are they publicly traded?
I don't know.
I don't know if they can, but I hear you, let's give them a thumbs down. Right? I often get like Nestle. How many people hate Nestle? Yeah, right? So, and again, everyone's going to be different, right? So when it comes to this, everyone's going to have a different level. I will say that, I don't know if people have been following this, but there's about to be a new company on the stock market. The largest company in the world, Aramco. This is the Saudi Arabian oil company. Do people know, have you heard about this Aramco IPO? So this company is bigger than Apple. And so if you have a couch potato approach, if they do their IPO and it goes through the way everyone's expected, that's now going to be the #1 holding in a couch potato portfolio, is Saudi Aramco. Oof. So needless to say, I was like, hell no, I can't do this. At the time, there were no resources available, right? So I started building my own sustainable portfolios, right? And the framework that I use is, you can see it's still a mix of stocks and bonds. For sure. We're going to be nice and diversified. Except I break them up between what I call doing less evil, right? And this is still large, global, multi-billion-dollar companies. We just got rid of all the evil stuff. And again, everyone has a different idea of what that means. And that allows us to carve out part of our portfolio for green stocks. So things like renewable energy, clean technology, water infrastructure. There are a whole bunch of these funds that are available now. But again, these are the things that you believe in. They do tend to be a little riskier, so we don't want to put all your money into these things. We carve out part of your portfolio for green stocks. As well, same thing with the bonds. Most of it is doing less evil. We typically just do like government bonds, right? Safe, boring, right? Simple. And then what that does is it lets us carve out part of your portfolio for impact bonds. Things like OREC, CoEnergy, community bonds, microfinance. There are a bunch of really, really cool options there. So the first model portfolio, I was inspired by the couch potato portfolio. So my first portfolio, I called it the organic couch potato portfolio. Right? Yeah, not bad, eh? And and this was like simple. This was like the first thing. I just kind of got rid of the worst of the worst. But unfortunately, there was still a fair bit of fossil fuels in here. And I had a client come to me and she was like, Tim, not one penny. Like she was literally a pipeline organizer. So she like spent her day protesting pipelines. And she was like, Tim, not one penny in fossil fuels. Darn it, how am I going to do this? I was pulling my hair out. So that's when I came up with my fossil fuel-free portfolio. So the innovation I had here is that instead of doing it by country, so like Canada, US, the rest of the world, instead what I do is global sectors. So we do like global real estate, global healthcare, global industrials, global consumer, global tech, right? And that allows us to pull out, so no energy, no mining, no utilities that burn coal, right? And then we can replace them with some of the green sectors, so like water and clean tech and green energy and environmental services, which is companies that make money cleaning up pollution, right? So this was really cool, but you can see here it's kind of complicated, right? Like all those slices of the pie, oh my goodness, that's such a pain to be able to manage something like this. So fortunately, over the last year or so, there's some really, like fossil fuel divestment has really taken off. And there are now a lot of new funds that are available that give us that global diversification without any fossil fuels. So that allowed me to create my easy as pie portfolio, hold the fossil fuels. And so this is now like the simplest way I've come up with for people to invest in, it's still in like global stocks, but getting rid of all fossil fuels, having divestment there. So, these are just a few models. I have these model portfolios on my blog, sustainableeconomist.com. I have like the specific ETFs, exchange traded funds, that like, you can use to be able to replicate this. So I put all that information online for free. Again, we can go down that rabbit hole if you want, but I'm just gonna kind of skip over it because I feel like we're getting towards the end here. But just know that like, I do provide a lot of this research for free. And then, of course, everyone's like, well, Tim, how much money am I going to make, right? They assume lower financial return by doing the right thing, when actually the opposite is true. Now, to be clear, my benchmark is the couch potato portfolio, okay? So this is like a low-fee portfolio using ETFs, exchange-traded funds. If you own mutual funds, like the default setting for people is to like walk into the bank and buy mutual funds, your performance is going to be about 2% less. Because those are the fees that you're paying to the bank and to the advisor that sold you, the salesperson that sold you those mutual funds. So just know that like, if it's like you own like a mutual fund, I'm gonna beat the pants off of that in terms of performance. This is like to the highest standard is that couch potato. That's like what the like smart investors are doing, the low cost option, right? And our portfolios are still doing just as well, if not a little bit better. Obviously, with the fossil fuel-free approach, it's really going to be dependent on how the energy sector does, because we have no exposure to that sector. If as the energy sector has fallen, which it has over the last 5-10 years, you can see that the portfolio has outperformed. If we get like a bounce back and like energy stocks all of a sudden go up, then obviously that would underperform. So just kind of like keep that in mind. Past performance is not indicative of future returns. That easiest pie portfolio, the ETF, just like it hasn't been around for more than a year. So I can't put performance up here just because it's so new. But again, I expect it to continue this trend to do just as well, if not better. So again, I want to clarify that you do not need to sacrifice financial performance in order to divest. And then obviously, if the global transition keeps moving in this direction, away from fossil fuels towards the green economy, I expect my stuff to actually do even better compared to the benchmark than it has, right? And so again, I'm going to be very Canadian right now and suggest that we skate to where the puck is headed, right? That this is like performance in the era of Trump and Stephen Harper, that if we were serious about climate change and actually like move, like if we like listen to our students who are striking and like take this climate crisis seriously, then I would actually expect this to perform even better comparatively. So really that's it for me. A couple links here for you. I've got my website if you want help with your personal investments. You're like, Tim, I don't know what you're talking about. I need help. You know, I can help you. You can sign up for a free consult there. If you just like want the nerdy ETFs and like the hyperlinks and the research for free, you can go to my blog, sustainableeconomist.com. You can add me on LinkedIn or Twitter or whatever social media you want to follow me on. Thank you so much for your attention.